I wanted to spend a few moments having a look at a potential trade idea in Qantas, not necessarily because it is Qantas per se, but because it presents us with some interesting ideas and techniques that we can apply on a broader framework to other instrumentalities. It might seem that Qantas is an odd choice of an example, given Alan Joyce's almost pathological desire to run the company into the ground, and these words of Warren Buffett, where he does not cast the notion of investing or trading airline stocks in very much of a positive light. But if we look at Qantas from 2018, there are two things on this chart that I want you to pay attention to. The first is the high before the COVID blip, where the world ended. The second is the chart at the bottom, which is a peak to trough drawdown chart. You'll notice that Qantas has recovered from its COVID drawdown and is now banging up against that previous high. It is this previous high that presents us with an opportunity and a learning experience. If I look at this on a slightly longer time frame, we can see the somewhat checkered history of Qantas. We can see mile gains in the late 90s. For the early part of 2000, the stock essentially went sideways, fell over with the GFC, took multiple years to recover, and this is one of the problems that people face when they invest in what they consider to be blue chip shares. Your blue chip share can go sideways longer than you could ever possibly conceive, and this was the situation with Qantas from the end of the GFC through to 2018. It effectively took it 10 years to recover that ground. If we look at it now, we can see COVID, recovery from COVID, this current running into resistance. If I chop this down to a weekly chart, my preference for trading equities such as this is to use a weekly chart. I'm not interested in the noise that they generate on a day-to-day basis. That is pointless. Yes, it will keep you entertained and you will enjoy the experience, but it might not make you profitable. My approach is to try and set myself so that I get very long-term runs out of stocks. I don't really care what it's doing next Friday. I want to know what it's doing 52 Fridays from here, and hopefully it has cooperated with my initial assessment. Breaking this down, we have the price chart, we have volume, we have a filter. You will have seen these before because I use them frequently on my charts. This is just a long-term background filter that gives me a sense of what the long-term trend is. And we can see that at the end of the first quarter this year, it popped positive. It's been a little bit of a noisy and a bumpy ride, and volume has not been in any way explosive. There's been no great confirmation of any upward move, but the progress has still been there. We can see that price retreated in the last session away from that previous high, so the initial challenge failed. That to me is not a negative thing, that is just a thing. I don't read a great deal into it at this stage because it's a singular one-off event. We do have a little bit of chop around there. 750 seems to be problematic. But again, I'm looking at this from the perspective of using it as an exercise. So what we have is this failure to breach a previous high. We have a fairly reasonable line of resistance. The reading of this then is such that a move beyond this point is a positive thing. A fall back from this point is a negative thing. So we are back to this wonderful notion of we have a binary setup. Price either moves forward and confirms what we want to do, or it falls away and it confirms our decision to do nothing. I mention do nothing because do nothing is an important thing. A lot of traders forget that to take no action is an action. And often in trading, the most important thing you can do is nothing. It is to sit and wait. For example, at present, I would not be buying this stock no matter how positive it appeared. simply because it is sitting below a significant previous high. This raises the question of how do we determine at what point beyond that high do we engage the stock? There's a few things we can look at, but I want to slightly digress and talk momentarily about volatility. Perhaps the most misunderstood concept in trading. If I were to say to you that from the period under investigation on this chart, the average historical volatility of Qantas, measured over a 15-week period, is 34%, many of you would go, good God, that's high. My response to that would be high compared to what? Because volatility is idiosyncratic to the instrument. The red line along the bottom is historical volatility of Qantas. The blue line is its average volatility. At present, it is sitting below its average volatility. It may not seem that way because people confuse trending with volatility. Trending is simply the capacity of prices to autocorrelate. Volatility effectively asks the question of how far, how quickly, and that is a relative question. But it does in some way point us in the direction of how we might consider setting up some form of trigger for this. To answer this, I've looked at the notion of a different measure of volatility. The chart along the bottom is ATR, average true range. The average true range for Qantas at present is sitting at 35 cents. It has been trending up, as you would expect if you look at the size of the candles in the past 6-8 sessions. They're quite large. They will expand the average true range. But this gives us a pointer as to what we can use as a mechanism to trigger us in. And the mechanism is quite simple. It is also universal. You take the high from the previous candle, which was 765, that is that spiky candle you can see, plus a single ATR gives you a price of $8. A close above $8 would trigger me in. The question then becomes one of, well, why not just go when it breaks through resistance? Because you can get a situation of failure where you get a week where resistance bisects the candle and then collapses back. You need to understand the difference between breakout and breakthrough. You also need to understand the notion of sitting and waiting for a confirmatory signal. You need a mechanism to tell you to go. Our setup is this notion of resistance. The trigger is a breakout above and beyond resistance, and you can use price to do that. The interesting thing about this mechanism is it's universal for setting trigger points for any instrument you come across. There is very little point having a trading instrument or a trading system that is not universal. Anybody who tells you that you need a special trading system to trade given instruments probably doesn't understand enough about trading, because they would understand that price is a universal concept, the application of volatility to price is a universal concept, and the application of using a subset tool such as ATR and applying it as a mechanism of determining breakouts is a universal tool.